All right, welcome everyone to Taxes Before and During Retirement. In today's presentations, we're going to be talking about some of the differences in both surcharges and taxes that you'll tend to encounter once you reach retirement and how those are different from what you'll be paying while you're still working. As we go through the presentation, just remember there are 6 different presentations that we go through every quarter. So right now we're doing the taxes before and during retirement. We still got estate planning and fundamentals of investing this quarter. As we go through the presentation, any questions that you have, feel free to put them in the Q&A and I will address them as we get there. So first, just to kind of display how confusing some of these rules are, we're going to start with a tax brain teaser. So Bill is retired and has a gross income of $72,725. That puts him in the 22% federal tax bracket. We're kind of ignoring state taxes for the purposes of this exercise. This includes $40,000 in IRA income that he distributes, as well as $38,500 in Social Security benefits. Bill wants to go on a road trip, so he takes an extra $1,000 out of his IRA for funding this road trip. How much tax will he owe on this $1,000? Well, if he's in the 22% federal income tax bracket, we would kind of expect that he would be paying $220 on the $1,000 that he took out. And we'll talk more about why this is, but in total extra taxes that he owes, it'll actually be $407. And this is because of a quirk about how Social Security is taxed. So he's paying an effective income tax rate of 40.7% on that income in this case. So remember, as you're doing tax things and making tax decisions, do seek professional guidance. The type of professional that you're looking for tax advice is a CPA, Certified Public Accountant. Some of the things that we end up paying, we want to understand the differences in is traditional IRA distributions, where we're going to be paying ordinary income tax on that money. We've deferred those income taxes for our whole working life, and then when we pull it out, it's going to be taxed as ordinary income. And then we have Roth money that we never took a tax deduction on. That's growing tax-free, and we can withdraw all of the money tax-free. So some things that are going to change in retirement as far as tax planning during the accumulation phase, you're mainly thinking about just the taxes that you pay and have withheld from your income. You might have some investment income or things like that as well. As we move on to the distribution phase, you're gonna not have access to some things that you had before, child tax credits, employer medical plans, contributing to accounts, or the ability to, kind of contribute to things to reduce your taxable income. We do have more flexibility with several of our tax strategies in retirement, because you can decide, aside from required minimum distributions, which we'll talk about later, how much taxable income you're realizing based on how much you take out of pre-tax accounts. Some things that are going to be new are Social Security, required minimum distributions, paying for Medicare, and long-term care, which we don't talk about a ton in this presentation. But you get that control over what you're distributing from your IRA or what you are selling from a taxable account. So you have a lot more control over what your income is year to year, and this allows for a lot of different strategies. Taxes are also paid a little bit differently. You usually, when you're doing IRA distributions, you can either have withholdings set up directly, or you can do estimated payments throughout the year if that's preferable to you. So there is several different gotchas in retirement tax planning in terms of the fees that you might end up paying. And a lot of these are sudden kind of cliffs that you can go over and make things much worse for yourself. So one of the things we want to do is understand what our tax exposure is related, especially to Social Security and Medicare, and have a strategy for realizing income in years where it won't cause too much extra taxes and fees, or we're trying to minimize that. So as we're looking through retirement, we kind of look at it in 4 stages, and we'll come back at the end and kind of give an idea of what things you should be thinking about in each of these stages. So in pre-retirement, you're working, saving, making sure you have enough to go into retirement. In early retirement, it's the go-go years. You may be spending quite a bit more in these years. In middle retirement, things slow down. And then late retirement, you're focusing on estate planning and making sure everything is in a good state for your heirs to inherit it. So some things that maybe you haven't thought about in your retirement plan, we need to take into account inflation, longevity, which can be very both unpredictable how long you live, as well as very based on what family you happen to be in. Thinking about the different expenses that come up, and healthcare, especially long-term care, can be surprising to some people as well. So the first key thing we're going to look at is understanding what your after-tax retirement savings picture looks like. Because to fund expenses, you can't do it directly from an IRA or other pre-tax account like a 401k. So say that you have a balance of $500,000 in your pre-tax 401k or IRA. That's not really funding $500,000 worth of expenses for you. Generally, you wouldn't take it all as a lump sum. But if you did and you were married filing jointly, depending on what exact other things are going on, if you ended up in the 24% tax bracket, that would be $380,000. In the 32% bracket, it could be $340,000. So a piece of all that money in your pre-tax account kind of belongs to the government and not to you. So you have an investment account that's kind of a shared balance between you and the government. And it depends what tax rates will be when you're pulling out the money, how much of it is yours. In addition, you can't just never take money out of these pre-tax accounts. Eventually, since the government's let you defer taxes on it for so long, eventually they want to get those taxes. And there's 2 ways that that might happen. One is required minimum distributions. So depending on exactly how old you are, these will start at age 73 or 75. If you're born after 1960, it's 75. These are the amount of money that the government does make you take out every year. So once you hit 75, you'll have to take out something like 1/26th of your account balance, and then it kind of ramps up from there. It's more and more every year. So you'll have to take out a lot of the balance over the course of your life. This graph is just kind of to help illustrate if you have an account that's continuing to grow, depending on your tax rate, what you might end up pulling out over time. So the lower tax rate that you end up paying, the more money will actually go into your pocket from your distributions. Can be significantly different depending on whether you're in a higher tax bracket or, in the extreme case, you can even end up in the 0% tax bracket for a lot of your income. So now I'd like to take a look at Social Security and Medicare. These are kind of two of the biggest things that's important to understand a little bit about in terms of not just going into higher marginal brackets, but with both Social Security and Medicare, if you realize a little bit more income, they can put you off a cliff that makes you end up paying either higher taxes or fees, depending on whether you're talking about Social Security or Medicare. So looking at Social Security taxes, this is kind of where we come back to Bill. I don't want to get too in the weeds about the exact math that's happening here. If you'd like to look up how provisional income and Social Security works, feel welcome to do so. But depending on how much income you have between Social Security and other income sources, Social Security is taxed differently. So this is what happened to Bill. He had Social Security taxes at a lower tax rate, and then he pushed his AGI over a cliff that made him realize a higher percentage of his Social Security taxes as taxable income in a given year. Depending on how much income you have, what's called your provisional income, which is a combination of part of your Social Security income and all of your other income, you can pay taxes at either 0%, 50%, or 85%, or sorry, that's not a tax rate. You are paying taxes on either 0, 50, or 85% of Social Security. So only a portion of it will be added to your taxable income each year. This is one of the things, I've actually never heard it called the Social Security tax torpedo. Apparently that's a term for that specific thing. But we're going to see something very similar when we look at Medicare. So his total taxable income is higher, and as a result, he's paying his marginal tax rate on more money with more of the Social Security included, and that's where we got this 40.7% that he's paying extra. So one thing that you might consider with Social Security is working. Oh, did I actually missed a slide there? So we have a few different retirement approaches, and these will interact with Social Security differently. One is you can retire completely. You can semi-retire and continue to work a little bit in your existing job. You can also semi-retire and do some sort of passion-driven career, and you can retire and volunteer. Retiring completely and volunteering are pretty similar, but there's some extra considerations if you're going to be earning income while you're taking Social Security. So Social Security, the benefit that you actually receive is calculated based on your highest 35 years of earnings, as well as when you start taking it. The earlier you take it, the lower amount that you'll get for your lifetime benefit. You can start it as early as 62 or as late as 70. And the higher your income is for those 35 years, up to a point, the Social Security wage base, I think you pay Social Security taxes up to about 184,000 in 2026. So up to that point, the more you earn, the higher your benefit will be. So one thing that's nice is if you don't have 35 years worth of working income, even if you're only earning a little bit, you can still, increase the amount that you paid in some of those 35 years by replacing low earning years. Another consideration is that if you are trying to claim Social Security early, meaning before your full retirement age, this is going to be 67 for most people. You will have to give back $1 of your benefits for every $2 that you earn over 24,480 in 2026. That's another number that's kind of indexed for inflation, but it's pretty low. So if you're trying to claim early, but still have any significant amount of income, you're not actually going to receive that much of it as a Social Security benefit. So generally, if you are continuing to earn a significant income, it's better just to delay claiming Social Security. However, the withheld amounts are added back into the calculation for your full retirement age amount. So you do get some of it back potentially, depending on if there's years to replace that income. One thing that is, kind of a downside is if you're continuing to work and collect Social Security even into the years in which you retire and you're not replacing higher earning years, you're still paying into the Social Security program. And, unless it is replacing inflation adjusted lower 35 years of earnings, you're not really getting any benefit out that point. So now time to move on to Medicare. So we've got another example here. The fees that you end up paying for Medicare are called IRMAA. These are income-related monthly adjustment amounts. So for this example, we're looking at a couple, George and Martha. They have, are paying for Medicare Parts B and D. These have income-based thresholds that if you go over them, you're going to end up paying more money for them. Right now, their modified adjusted gross income is $341,500, and they decide to sell some stock to, buy a gift for one of them, let's say. So if we're looking at what we would expect them to pay in capital gains on that, plus the Medicare charges that are associated with having an income that high and net investment income, we would expect them to pay 18.8%. But in this case, we're going to see that since their income was already right up against one of these thresholds, where they would pay for their Part B premium $405.80, it's going to push them into this next premium bracket where they're paying $527.50. That means that each of them is going to be paying an extra $121.70 per month. In a couple years, these IRMAA charges are based on your income from 2 tax years ago. So for example, now in 2026, it would be based on your 2024 tax return that you filed in 2025. But a couple years from now, they're going to have to pay an extra $121.70 per month, which for both of them together is going to be $243.40, and that's a monthly charge. So they're going to end up paying almost $3,000 a year more because of this little extra income pushing them over this cliff. Likewise, on the it's less substantial, but on the Part D Medicare side, they're going to be paying an extra $46 a month. Or wait, or is it 9? Let's see, 22, yeah. So if we look at everything together, the extra charges are going to add up, since they're paying for a 12-month total, $1,460.40 for each of their Part B premiums, and then $260.40 for their Part D premiums. We're going to see that they pay an extra around $3,400 in Medicare expenses in total in the tax year that's a couple years from now. So if they did this in 2026, like the example, they'll be paying these higher fees in the 2028 year. But if you look at the amount of taxes that they paid here, it's kind of absurd, right? Because they went over this cliff. So they sold $1,000, got that extra income. There is taxes that they had to pay on the stock for the capital gains and net investment income. The stock sale triggered the new income tier for IRMA, and they ended up paying an extra, adding back in this tax, looking at 360.29, so something like a 363% tax rate. You don't often pay that with ordinary income taxes. So you do want to be really careful when doing income planning of these kinds of tax cliffs. Another thing we want to be aware of is when you should do Medicare enrollment. Coverage gaps can have penalties that follow you your whole life for Medicare, so you want to make sure to enroll at the right time. Generally speaking, once you're 65 or approaching 65, you can go ahead and enroll for Medicare. It's better to do it early than to forget. So in this example, Jim and Ann are 68. Jim retired at 65, but Ann is still working. They get coverage through Ann's employer, so they don't really need Medicare coverage yet. But it's still important that they do register for Medicare as soon as she retires, because in fact, you should do it before. You should do it when you're 65. But because you can't do it instantly, it takes a little bit of time. If you miss the enrollment window, there's a 10% base premium for life for each year that you delay it, or 10/12% per month. So it's actually a monthly charge. But if you're looking at even missing it for 1 year, this could cost, an extra $487 in premiums every year. So thinking about what that adds up to over a lifetime, because again, it's not just for the next year, it's for your entire life that these extra penalties follow you. So this can translate into, a $10,000 mistake just not registering on time. So make sure that you don't have those coverage gaps as you're thinking about retiring. I mean, again, you can have Medicare registered on top of your previous plan. So I would just always try and do it pre-65. But if you want to wait, you can also register for it just in anticipation of retirement, whenever that happens to be, or 65 if that's later, if you're retiring, earlier than that. The next thing we want to look at is how to use your different types of tax buckets and how to spend from them to efficiently use your money throughout retirement. So just having an example of someone who, we have Sam and Mary here. They each have a $450,000 pre-tax IRA. They both have a $60,000 Roth IRA. Then they have $300,000 in what we would call taxable assets. So they're not in a tax-advantaged retirement account, either pre-tax or Roth. And they want to spend about $8,500 a month, which, between Social Security, depending on what their benefits look like, could be very reasonable. So the conventional wisdom, and I'd say this is, it does depend on your situation for sure. But generally speaking, spending taxable money first, so bank accounts or a taxable brokerage account, and then spending tax deferred money, and then spending Roth money. This can vary on kind of what your goals are. One thing is, if you're charitably minded, these can get switched up a little bit because pre-tax assets often can go to charities tax-free, as well as you can satisfy your required minimum distributions with charitable contributions. We'll cover that a little bit later. but I think this is, kind of for most people, how you should be thinking about things. Spend taxable money, then tax deferred, then tax exempt. But there's something kind of missing from this picture, which is you can actually move money from these pre-tax buckets to these Roth buckets whenever you want and pay income taxes on that in the year that you do. This is called a Roth conversion. So something that we want to kind of add to this picture is in low income tax years, which early retirement tends to be, once you've retired from your job and haven't started Social Security, haven't started being forced to take distributions out of your pre-tax accounts, this can be a very good time to do some of those conversions. So anything that you, in a given year, decide to convert to Roth just counts as ordinary income. So if you want to convert $100,000, you take it from the pre-tax to Roth bucket, pay income on an extra $100,000 of income, and just have that taxed at your normal tax rates. This can be a very nice strategy, especially if you have a very large pre-tax balance. But also just it's much nicer for your heirs to inherit assets that they don't then have to pay taxes on. So if you had an income situation like this, where you have already filled up your, just with normal expenses, taking money out of the IRA to spend, you filled up your 10 and 12% tax bracket, say, but you have some room left in your 22% bracket, you might want to do Roth conversions just to fill up that bracket. This will help take away some of the tax risk later in your life, as well as make it so you don't have to do required minimum distributions, because on Roth accounts you don't. So what is a good situation to do Roth conversions? Anytime where you have an unusually low income year, it could be beneficial. Like I said, this is often when you've retired, but you aren't receiving Social Security pension or being forced to do RMDs yet. Those can be years where it's extremely good to do it. Business owners sometimes have highly variable incomes. So even pre-retirement, you may have years where your income is low enough that it makes sense to do some conversion. And then there are other reasons. I don't want to focus too much on the non-recurring medical bills, but any other year where you have something that happens that means what you're going to be taxed on is a lot lower. Maybe this is, yeah, I mean, it could be a lot of different things that would cause you to be in that situation, a year of unemployment or medical bills or large charitable contributions, could be a lot of different things. So what we're trying to do is one of two things. Either we're trying to keep our income below a threshold when doing Roth conversions. That would be those things like Social Security taxability or Medicare, IRMA surcharge cliffs. So we might want to do a conversion, kind of keeping in mind that we don't want to go into the next highest thing. Or we can try to fill up a bucket of income taxation that we think is particularly advantaged. For example, if in early retirement you're in the 10 or 12% tax bracket, I think it makes a lot of sense to fill those up for almost everybody. Some other things you can consider in managing tax brackets is if you happen to have insurance policies with a cash value, you often can borrow money against those. If you need money, you can sell Another thing you can do to fill up brackets is selling appreciated stocks. There are 0% federal income tax brackets for capital gains. So if you happen to be in those might be a good year to realize those capital gains. And then taking distributions from IRAs, 401ks in years where you have lower tax rates or doing those Roth conversions can make a lot of sense as well. So another thing that we can look at, I mentioned this earlier, so we have these required minimum distributions that we're required to take out of pre-tax accounts at some points. And there is actually another way called qualified charitable distributions that we'll now be looking at in this example. That's a more tax efficient way to give from pre-tax IRAs. So we have this example of a couple people who now are in required minimum distribution age. They're 74 and 75. They're in the 24% bracket. They're trying to give $5,000 to charity. And sort of the traditional way you would think about doing this is taking money out of your IRA, putting it in your checking account, and then donating from your checking account to charity. If you do this, you've satisfied your $5,000 RMD by taking money out of your account. The $5,000 is going to be taxable income to you this year. So the tax bill, if they're in the 24% tax bracket, is $1,200 for that money. So to do this charitable contribution, they have had to, essentially pay $6,200 to make that contribution in total. If we're looking at doing a qualified charitable distribution, they're going to send money directly from their IRA to the charity. The charity gets the $5,000 still. It satisfies the $5,000 RMD. This income is not included on their tax return, so they're not paying taxes on this at all. Since the tax bill is zero, it only costed them $5,000 out of the IRA to give that to charity. Once you have hit years where you are able to do qualified charitable distributions, you're also not limited to just the size of your required minimum distributions, but you can't use this strategy prior to when, well, actually, I guess you can do it a little bit prior to when RMDs start. I think you can do it starting at 71 or 72. I can't remember. It's whatever the RMD age used to be, and they've been kind of pushing that back over time now to 73 and then to 75. But generally speaking, you can give more through qualified charitable distributions than the amount that your RMD is. So looking at how estate planning can interact with tax planning for retirement, one thing to consider is how you want to organize your assets for kind of giving the most to your family, because taxes work differently depending on what type of assets that you're giving to your family. I kind of don't like this specific example because it's actually doesn't work in all states or jurisdictions. So we won't focus too much on the specific example. But the concept here is when you are giving appreciated taxable assets, whether that be your home or appreciated stock in a taxable account, they receive what's called a step up in basis. And that means, so usually when you sell a capital asset, you have to pay taxes on the difference between your basis, which at most times is what you bought it for, and then what you sold it for. That's sort of the gain that you're paying taxes on. When you pass those types of assets on to an heir, they get a step up in basis. So the amount that your heirs would have to pay taxes on is the difference between the value on your date of death and when they sell it, not the original value. So kind of no one has to pay taxes on that gain. That's what the step up in basis is. So there's several things. If you want to get into the more advanced strategies, I would go ahead and consult a CPA in your state. I wouldn't necessarily be trying to do like this example and title assets in a different spouse's name for the date of death. But do realize that these are, in general, more advantageous assets to pass on to your heirs than with like pre-tax assets, like a pre-tax 401k or IRA. So speaking of those, let's look at what happens when Kyle, 40-year-old son of Pamela here, inherits her IRA. So when Pamela dies, she has a beneficiary designation on her IRA that gives everything to her son Kyle. The balance of the IRA is $400,000. We're assuming a 6% annual rate of return on this account. And there's kind of two scenarios that we want to look at to understand how this taxation works. So there's two different things that Kyle can do that are kind of the extremes, and then you could also do something between these. But Kyle has 10 years to take all of the money out of the account. So if the owner had already started RMDs, you'll have to continue those RMDs, but you also have this 10 years to just remove all of the money from the account starting in 2020. So with the 6% annual return and 400,000 balance, the annual distribution that Kyle would be taking would be a little over 54,000. So in each of those 10 years, Kyle is adding that to his taxable income and having to pay income taxes on that. So it's going to push his income up a little bit in all of those years. But if he doesn't take distributions throughout the 10 years and kind of waits for it to all accumulate at the end, then since he hasn't been taking money out, the account balance at year 10 is going to be a little over $700,000. Kyle is then going to have to take all of that money out and realize all that income in a single tax year. So this is going to result in a much higher tax situation for him, because even if he's married, he's very likely going to be in the highest federal income tax brackets, and likewise for any state that he lives in. I think New York might have an income tier above $1 million, but pretty much every other state that has a graduated income tax system, that's going to put you in the highest income tax in kind of at state and federal. So definitely want to spread those distributions out over time to be paying less high tax rate. So as we're getting towards the end of the presentation here, this is, I mentioned early in the presentation, kind of like what things should you be thinking about in each stage. So pre-retirement, you want to be thinking about if you have enough savings, kind of adjusting for taxes because you don't get to spend all of it in pre-tax accounts. The government owns part of that, so you want to make sure you have enough to pay the government and fund your expenses. You might also think about funding Roth accounts. This is a good way to pay some taxes earlier but have more flexibility in retirement. If you have some Roth accounts, it can be really helpful if you have a really expensive year for some reason. You can fund some of that out of those Roth accounts, to avoid maybe pushing yourself into the next IRMA bracket or something like that. And you still have a bit of flexibility to be able to fund those expenses. You can also potentially use after-tax assets like your bank accounts. In early retirement, you want to be thinking about what your Social Security decisions are and understanding Medicare taxation once you get into Medicare years. You want to be aware of those IRMA brackets in all of your decisions as to what income to realize and when, as well as before you start Social Security and you're not into RMDs yet, think about doing Roth conversions, filling up your tax brackets in low income years so that you have more flexibility with taxes later on. In middle retirement, you're going to hit RMD age, probably at 75 for most of you, and you'll want to think about how to manage that forced income. That tends to be much easier for people who are charitably minded, since you can do the qualified charitable distributions up to $111,000 per year, I think. So unless you have pretty large RMDs, that becomes pretty easy to manage. If you're trying to do a lot of charitable giving, it becomes a little bit harder otherwise, but that's a reason to consider doing some more aggressive Roth conversions early on in retirement if it looks like you're going to have large RMDs, because that's going to allow you to have more income you don't have to take out of tax advantaged accounts when you get there. And then in late retirement, think about organizing your assets for tax efficiency for your estate. After-tax assets, especially appreciated ones, are great for your heirs to get. Roth accounts are great for your heirs to inherit. And then finally, pre-tax accounts are another thing that they can inherit, but they will have tax consequences themselves, since nobody has paid income taxes on that money yet. So thinking about retirement, you want to understand which taxes you'll be faced with and the IRMA surcharges and when those might come up. Anticipate how you're going to tap various types of assets and in what stage of retirement, and then kind of try to think about managing taxes throughout retirement for the lowest overall taxes, and to manage your tax risk as opposed to just trying to minimize your taxes in a given tax year, because that may put you in a spot where you're forced to have a high income in later retirement with high RMDs, forcing you into high Medicare costs and high tax brackets and all the rest. So as you're thinking about managing these cash flows, again, think about it throughout retirement. Be aware of IRMA surcharges and Social Security taxation. Those can be costly mistakes. And I think one of the most costly might actually be not registering for Medicare on time. So again, be very sure that you're doing that in anticipation of when you actually will need it. And then another thing to consider is this is pretty complicated stuff. So you might consider working with a professional. I think a lot of people like to work with tax planners, CPAs, potentially a more holistic financial advisor if that's appropriate for your situation. But that can be very helpful for understanding these complicated rules and kind of making good decisions for a full retirement plan. All right, so I don't see any questions in the Q&A. I will stick around a little bit here, but feel free to email me if you have any questions. And then don't forget that estate planning is our next webinar next week on June 10th. So if you'd like to learn kind of more about some of the considerations in estate planning, then that would be a good place to do that. All right, thanks everybody.